The phone rings at 4:51 a.m. You are already awake. You have been a senior economist in the Federal Reserve's Division of Financial Stability for 3 years. Your job, most days, is to model systemic risk. You build frameworks, you run stress tests, you write memos that circulate to people whose names appear in Senate confirmation hearings. The work is precise, measured, and largely invisible. Today is different. A regional bank in the southeastern United States, $47 billion in assets, 280 branches, 1.4 million depositors, has just had its overnight liquidity facility request denied by its primary regulator. Not because the request was improper, because there isn't enough eligible collateral left to secure it. The bank's bond portfolio, accumulated during the low-rate era, has marked down 31% since the hiking cycle began. The hole is not theoretical. It is $6.2 billion real and present and accelerating. You open your laptop. The model is already running. Day 1. By 6 a.m., you are in the building. The Eccles Building in Washington is quiet at this hour. Marble floors, high ceilings, the particular silence of an institution that has existed since 1913. You badge through 3 checkpoints. You know the guards by name. They do not smile this morning. Your team assembles in conference room 4B. There are 11 of you. Margaret Calloway, your division director, stands at the head of the table. She is 54, silver-haired, formerly of the New York Fed, and she speaks the way experienced central bankers always speak, in precise, de-escalated language that communicates urgency through understatement alone. The situation at Meridian Federal is developing, she says. We are in monitoring posture. You know what monitoring posture means. It means the posture before the posture that matters. The bank's deposit outflows began at 2 a.m. Social media accelerated them. By 5:30 a.m., $340 million had left through digital channels. The number is not yet systemic, but numbers like that do not stay still. You pull the contagion model. 3 other regional banks share Meridian's interest rate exposure profile. 2 of them are larger. One of them is a primary dealer counterparty. You run the correlation matrix and file what you find. You have not gone home. The outflows at Meridian reached $2.1 billion overnight. Day 2. The FDIC has been notified. The OCC has activated its contingency protocols. The Fed's Board of Governors convened a closed session at midnight. You were not in the room. Your memo was. This is the thing you learn on day 2. In a crisis, the work does not change. The pace changes. The stakes change. But the actual task, build the model, run the numbers, write the memo, pass it up, remains the same. The machine does not become a different machine under pressure. It becomes a faster version of itself. Margaret pulls you aside at 7 a.m. Your contagion analysis. Walk me through the methodology. You do. 12 minutes. She asks 3 questions. The third one you don't have the answer to. You tell her that directly. Find it, she says. Not unkindly. That is simply the standard. By noon, you have it. The answer is worse than the placeholder you had used. You update the memo. You send it up. You do not know what happens to it after that. You have learned not to track documents by their destination. You track them by their quality. Day 3. Meridian Federal is placed into FDIC receivership at 6:17 p.m. The announcement is made after market close. Deliberately. The language is controlled, institutional, designed to interrupt panic rather than confirm it. Depositors are made whole up to the $250,000 insurance limit. Above that, the math is less clean. You watch the statement go out on the wire from your desk. 1.4 million depositors. Of those, approximately 11,200 held balances above the insured threshold. The aggregate uninsured exposure is $3.8 billion. Some of those accounts belong to small businesses. Some of those businesses will not survive a 60-day claims process. You do not feel what you expect to feel. What you feel is something closer to calibration. You note the number. You note what it implies. You move to the next model. Pacific Corridor Bancorp, $89 billion in assets, headquartered in Phoenix, reports a 14% single-day deposit outflow. The number lands in your terminal at 9:44 p.m. You run the scenario immediately. If Pacific Corridor follows Meridian's trajectory, the contagion is no longer theoretical. You send the update at 10:12 p.m. Margaret responds in 4 minutes. Be here at 5. Day 5. The Federal Open Market Committee convenes an emergency session. This does not happen often. When it does, the building feels different. Not louder, but denser. There are more principals in the corridors. The conversations stop when you pass. Not because you are excluded, because everyone is processing the same variables simultaneously, and there is no surplus attention for anything else. The Fed announces a new emergency lending facility. Banks can now pledge underwater securities at par value as collateral. The discount window stigma, an artifact of decades of institutional psychology, is being managed through coordinated messaging. Your memo contributed 3 paragraphs to the facility's design. You know this because Margaret told you. She is not someone who offers information like that without purpose. You file the distinction away. The outflows at Pacific Corridor slow within 6 hours of the announcement. Not stop, slow. The difference between those 2 words is where most of the work lives. Day 9. The immediate crisis has not ended. It has entered a new phase, slower, more structural, conducted through regulatory channels rather than market channels. This phase is, in some ways, harder to work inside. The urgency drops below the threshold where the body registers it as urgency. What remains is sustained precision under sustained pressure. That is a different kind of difficult. The actual lending through the window is $34 billion in the first week. The number that matters more is the deposit stabilization signal. Withdrawal rates across the cohort of at-risk institutions have declined 73% since the announcement. You write the post-incident analysis framework. It will eventually become a working paper, then possibly a public speech by someone whose name you will recognize from confirmation hearings. Your name will not appear in any public version. You know this going in. The institution is the author of its own decisions. The people inside it are components of the analysis. That is not a complaint. It is a structural description. Day 14. You go home. You sleep for 11 hours. Your partner has left dinner in the refrigerator with a note that says only a date, 2 weeks from now, circled. A dinner reservation you had made before any of this began. A reminder that the calendar outside the building continued without you. You lie in the dark and run through the sequence. The 4:51 a.m. call. The $6.2 billion hole. The 1.4 million depositors. The 11,200 above threshold. The $3.8 billion in uninsured exposure. The facility. The 73% withdrawal stabilization. The working paper that will not have your name on it. You do not feel that the system failed. You feel that the system functioned exactly as designed, absorbing stress, distributing cost, stabilizing the mechanism. That some of the cost landed on people who did not design the mechanism and could not see it coming is also part of the design. You have learned to hold those 2 things simultaneously without resolving the tension between them. That is, you think, what the work actually requires, not comfort with moral ambiguity, precision about it. Day 15. You return to your desk on day 15. There is a new memo in your queue. Pacific Corridor Bancorp has requested a supervisory review of its capital adequacy framework. You open the file. The model is already running. Somewhere in the lobby below, a new analyst is collecting her badge from the security desk. She graduated from the University of Chicago 11 months ago. Her dissertation was on interest rate transmission mechanisms in heterogeneous banking markets. She is 24 years old, and she is very good at what she does. She does not know yet what the work costs at sustained altitude. She does not know what it feels like to sit inside a building while 11,000 people's financial futures circulate through your models as variables. She will learn both things. The institution will teach them to her the same way it taught them to you. Not through instruction, but through repetition, until the calibration becomes structural. The badge prints, the door opens, the machine takes 1 step forward. It does not notice her entering. It never does.